Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Wednesday, the 5th of March 2025. So as usual, before we kickstart the gist of today's Daily Dose, let's have a quick look at the disclaimer first. Alright, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of news flow, economic data release, and as well as the key price action movement on those respective broad-based cross asset classes. All right, so let us start with yesterday's movement of the major US stock indices first. So what I could see over here is that yesterday US major stock indices was rather chaotic, as you could see on my screen over here. Yep, I hope that everything is good. Yeah, so what I could see is that at the start, okay, this is the SPX 500. So at the start of the US session, the SPX 500 actually tumbled. All right, it actually went down to, I think, an intraday loss of negative 2%. Yeah, close to negative 2%. And what you could see over here is that after that, during the middle part of the US session, there was actually a strong recovery. All right, there's this strong recovery over here. So what causes this strong recovery during the intraday session was there's just this particular news flow over here stating that the US Commerce Secretary Howard said that Trump administration may walk back on some tariffs, right? Because of this rather optimistic so-called we call it a statement by the Commerce Secretary saying that Trump will walk back some of the tariffs. Still recall that prior to yesterday, Trump actually made an announcement saying that he will implement 25% tariffs on Mexico, 25% tariffs on Canada, and a total tariffs of 20% being slapped on China products. And now we start to see tit for tat measures coming out from China, Canada, and even in Mexico as well, planning what I call it regulatory reactionary tariffs towards US goods heading into their country. But that was actually not, so market don't actually continue to buy such bluff again, where we start to see the market actually tumbled during the last 30 minutes of the US session. Okay, it went all the way down again on the SPX 500. Very similar was seen on the Nasdaq as well. Okay, it tumbled all the way down, and followed by also the Dow Jones Industrial Average. All right, so net overall, I would say that it's a rather very chaotic move, but towards the end of the US session, the market actually closed near their session low, which is also considered as a rather weak market price action behavior, despite we have this so-called earlier optimistic news flow coming out from the US Commerce Secretary stating that Trump administration may walk back on some of the tariffs. The market doesn't seem to believe that and starts to see or sold off the US benchmark stock indices throughout the last hour of the closing session of the cash US stock market. So overall, the SPX was down by negative 1.22%. The Nasdaq 100 fared better, why only down by negative 0.36% because of Nvidia and managed to actually help the fort. So Nvidia managed to close positive yesterday at 1.7% and managed to actually see a spill over some form of green shorts throughout the entire semiconductor industry, right, within the technology sector. But overall, what I could see over here is that there are more reds than green in the S&P 500 component stocks. So overall, I would say that the market breadth is still relatively weak, despite the fact that Nvidia managed to hold the fort and trigger a positive feedback loop in the entire semiconductor industry. But nevertheless, the other industry are much more deeper in the red, as you could see on the screen over here by the heat map of the S&P 500 intraday performance yesterday. These are all the component stocks. So then overall, the market breadth situation on the US stock market is still relatively weak. All right, so now what's interesting over here is that in early today's Asia session, like I mentioned that today will be very key. Why? Today will be the second day of the China 2 session, the parliamentary session, and today will be the most important. Why? Because Premier Li, the Prime Minister, which is the Prime Minister of China, will announce the growth target of China GDP for this year, and also other key metrics like the budget deficit, totally implying how much fiscal stimulus that the China top policy planners will actually engage or ignite this year. So that was a very positive reaction. Later I'll share more about that on the details of the remark or the speech that was being made by Chinese Premier League about 1.5 hours ago or 2 hours ago. So what I could see over here is that all the Hang Seng indices, which is considered as the proxy of the China stock market, much more embraced by international investors, all in the green right now, and continues to rally up from yesterday's pivotal support, which I highlighted on the Hong Kong 33 in our platform, representing the Hang Seng Index. So as we are speaking right now, the Hang Seng Index up by 0.95%. The very similar momentum on the Hang Seng Tech as well, 0.9%. The HSCAI up marginally higher, which is the China shares listed in the Hong Kong Stock Exchange, up by 1.10%. And even the mainland benchmark stock indices is almost unchanged right now, right at 0.04%. So what happened over here is that in today's early AI session, which about 2 hours ago, so China has officially set this year target for GDP at 5%, despite we know that their external demand likely to get hit because of the US tariffs that is coming into play, which is an additional 20% tariffs, and potentially there could be more coming forward going forward, depending on how Trump wants to view things from here. So in order to achieve this 5% GDP growth target for this year, given the fact that the external environment due to trade tariffs will be less lukewarm as compared to 2024, China got to actually have other forms of, we call it avenue to achieve this 5%, and very likely it got to be domestic economy. So how do they achieve that over here is that indirectly what they did over here, let me share the table. We have a table. Yeah, so this is the main targets. So what you could see over here is that the headline deficit ratio. All right, so they are up by 1%. So previously was 3% over here. So they came out at 4%. All right, 4%. So they are allowing the budget deficit to widen. And also what we could see over here is that there's this special sovereign bond. They will issue 1.3 trillion over here, but came in slightly below market expectation. Market expectation is 2 trillion. Previously was last year was 1 trillion. But what's interesting over here is that they increased slightly the local government special bond to 4.4 trillion from 4 trillion last year. So market is almost in line with the 4.4 trillion as well. But there's another one that didn't Bloomberg News didn't actually put over here, was there's additional 5 billion yuan of new special sovereign bonds for Chinese big banks. So this is more for a recapitalization of Chinese big banks balance sheets over here. So what market is viewing over here is that based on this wider budget deficit, more the additional 5 billion yuan of special sovereign bonds that's not highlighted over here, the local government special bond 4.4 trillion that is came in within market expectation. Overall, as 2025 unfolds, that in order for China to hit the 5%, it got to actually have more stimulus to boost consumer confidence and business confidence and jumpstart their domestic economy, because we know that the external economy, we cannot be totally reliant to hit that 5% anymore solely because of the Trump trade tariff. So that actually also created a positive feedback loop into the Hang Seng indices right now as we are speaking. Just now I flashed you all the current positive intraday price movement. All right. So then over here is that the FX market, we start to see the euro dollar actually rallied. There was a strong rally in the euro dollar yesterday. So we know that this is a 5-day rolling performance chart of the dollar against the other major currencies. So I could see that the dollar was the weakest against the euro. Secondly, it came down the weakest against the sterling. So the reason why the dollar is so weak over here against the euro and against the sterling, because there's this particular news flow that is supporting the euro dollar yesterday was okay, over here, Germany. All right, so Germany, the current government decided to actually increase their physical spending. That means previously German has this debt ceiling that they can't exceed debt beyond this level. So they actually try to remove the debt by issuing more government bonds for them to actually spend more. So what I could see over here is that there's this thing. Okay, that this new came that the German new government agreed to create a 5 billion euro infrastructure fund and overhaul borrowing rules. That means what they do over here is that they want to actually engage in more fiscal spending to jumpstart the Eurozone economy, and as well as to actually come up and increase defense spending, despite we know that the last 2 weeks indirectly US White House doesn't seems to be willing to actually increase their spending in NATO, and also Trump seems to be in favor of having a quick peace deal between Ukraine and Russia without any form of security guarantee coming up from US. All right, so that actually spoke Europeans leaders to actually come up with some form of emergency meeting last Saturday, where they actually have this plan of creating a special fund where they will pool money together to increase their defensive spending, to actually have a counter measures if there's any form of Russian aggression in their backyard, given the fact that US now does not want to implicitly provide any security guarantee to Ukraine, despite the fact that they want to have a push a peace deal through. So that actually causes the euro to spike up over here, but the spike up in the euro, right, very interestingly comes very close to a some form of resistance level. So if you look at it in translation, we know that the dollar index has the most heavyweight currency on the euro. So you see the dollar index plunges yesterday, and why it plunges, right? It plunges close to the 200-day moving average and close to our medium term support level of the dollar index at 105.50, which is also the pullback line, this green line here. Okay, maybe put it in dotted line, this dotted green line, which was the former triangle like range resistance, broke out, exposed US presidential election, retested it on early December, rallied, and right now there's another retest of it again. All right, at this level over here, and also coming close to the 200-day moving average as well. So potentially what it means that over here, we got to look out for some signs of positive price action thereafter. So if we start to see signs of positive price action thereafter, especially on the weekly candle over here, because if you look at the current weekly candle, is rather bearish. Okay, one black Marubozu. So because right now we know that it's still early, 3 more days before the weekend. So let's say if the weekly candle managed to form a bullish reversal candlestick after a test at this key medium support level of 105.50, key medium support level of the dollar index, that means that the dollar strength is not yet game over. All right, but until now it's still uncertain, but there could be some signs of a stabilization in this ongoing dollar slide that was seen in the last 2.5 months. All right, because the high was of 13 January. So something to take note of. All right, because of the dollar index now is back at a key medium-term support level of 105.50, which is being defined by different form of technical elements. Right, graphically, the pullback support of the former triangle range resistance now turns into a pullback support, the 200-day moving average. And if we do the Fibo retracement of that previous medium-term up move or uptrend from 30th of September all the way up to the high of 13th of January, yeah, 13th of January, that coincides with the 50% Fibo retracement as well. Right, so something to take note of as the dollar index, the sell-off of the dollar index now is at a key inflection level or a make or break level. All right, so more price action got to actually form to take note whether this is indeed a key strong bullish reversal for the dollar index to continue its up move. right? But for sure, if it starts to break down below this level, then that dollar strength that was seen in September last year will be in great jeopardy, and we may start to see a very, very choppy dollar index or dollar movement throughout of 2025. Okay, so yeah, so that is the key highlight I want to actually cover for you guys at the start of today's daily dose of market insights over here. So with that, now let us now jump straight into the short-term intraday pardon me, bad cough. Short-term intraday technical outlook, starting from the FX market first. All right, so with that, let me expand my screen so that you guys could have a better view of the chart. Okay, good. So I believe, yeah, everything is good. Yeah, so now let's start with the euro dollar. Okay, so for the euro dollar, yesterday we attempt to play that short-term bearish bias. So the bearish bias didn't turn up and squeeze all the way up to 0.63 level. Okay, 1.063. So 1.063 level was in fact this minor swing high area of 6th of December. All right, and also close to the 1.236 Fibo extension as well. And what we could see over here is that the hourly RSI now is at the overbought region. All right, so with that, given the fact that the dollar index is at a key support level, all right, and we know that the euro dollar is the biggest component weight inside the dollar index, I will not be so aggressive to flip into a bullish stance for today, given that the dollar index is at support level. So for the euro dollar, I will flip to a neutrality stance instead for today. So neutral between 1.0630 and 1.0530, which was our short-term pivotal resistance yesterday, broken out now turns into a pullback support level, right, on the intraday basis. So flipping to a neutrality stance between 1.630 and 1.0530 on the euro dollar for today. Unless price action can immediately see a swift down move below 1.0530 during the European session, we could potentially reinstate the bearish bias for the next near-term support level to come in first step at 1.0450 slash 1.0420 next. Right, so that's for the euro dollar. Now onward next will be the sterling dollar over here. So the sterling dollar, what you could see is that very interestingly, it also broke above the 1.2690 to 670 short-term pivotal resistance that we have yesterday, squeeze all the way up to the 200-day moving average. So that's our second resistance level at 1.2810. So this 1.2810 also coincide with the swing high area of 6th of December. And what's interesting over here is that after the test of that 200-day moving average, the hourly RSI has started to shape a very clear bearish divergence of three lower high that I could see that could flash out at the overbought region yesterday. Right, three lower high. So what it means that over here is that yesterday push up starts to see a slowdown in upside momentum or kind of a overstretch push up over here. So it also could translate to a residual push up. We call it the climatic move before that potential bearish reversal takes shape. So with that, we also do not have the conviction to actually be bullish right now, given of that bearish divergence that's been flashed out right after a retest at the 200-day moving average, I think as a resistance level, or stalling yesterday price action level for the sterling dollar on the upside. So with that, we will flip to a neutrality stance as well for today, neutral between 1.2810 and 1.2685. Only a swift down move below 1.2685 during the European session, potentially reinstate the bearish bias to expose the next near-term support level at 1.2640 slash 1.2610 in the first step. Below it, revisit the minor swing low of 28th of February. We saw confluence with the 20-day moving average, I think as a almost similar next near-term support level at 1.2560. So i.e. Flipping to a neutrality stance for now on the sterling dollar, neutral between 1.2810 and 1.2685. All right, so with that, let us now focus on the Asia Pacific currency against the dollar. So before that, let me look at the chart over here. So what I could see is that the dollar still remains strong against the Aussie and the Kiwi here. Okay, you try to bounce up as you're speaking right now because of that potential risk-off impact on commodities currency, especially with that tit for tat measures coming out from Canada, where Trump himself has already kind of made that move of implementing that 25% tariff on Canada goods heading into US. So that also dragged down the Aussie dollar, and eventually see also the Kiwi dollar being dragged down as well. So what you could see over here is that the Aussie dollar chart, all right, managed to actually do a bit of whipsaw at the short-term pivotal resistance level before inching downwards as we speak right now, and also didn't break above the minor descending trend line, which I drew earlier from the high of 21st of February. So take this level here as a whipsaw instead of a clear breakout of 62.60. So a bit of excess at 62.80. So using 62.80 as my short-term pivotal resistance level for today. So we'll still maintain that intraday bearish bias on the Aussie dollar. But first support level to look out for will be this level here. Okay, at 62 figure level, close to 62 figure level, a breakdown below 62 figure level exposes 61.75 next, which is the swing minus congestion area of 4th of February over here. Right, only an hourly close and a push up above 62.80 excess of that short-term pivotal resistance level will invalidate today's intraday bearish bias to see a squeeze up to revisit 63 figures slash 63.30, which is also the 20-day moving average, pardon me, acting as a resistance. A push up above 63.30 potentially sees a deeper minor corrective rebound scenario, exposing the next near term resistance level at 63.60 next. So if you do the Fibo retracement, 63.60 is the 76.4, yeah, 76.4 Fibo retracement. Right, so that's for the Aussie dollar. So having a bit of excess at 62.80 short-term pivotal resistance level, and we maintain that intraday bearish bias. Lastly would be the dollar yen. So the dollar yen plummeted as expected and almost hit our second support level that we highlighted at 147.95, which is which is the Fibo extension cluster as well. And if you go back in time over here, is the minor swing low area of 8th of October, and the lower limit of this medium term ongoing descending channel since the high of 10th of January this year. All right, so with that, right now after almost hitting 147.95, it managed to stage a bounce throughout the US session. So right now attempting to play with our first resistance level that we highlighted yesterday at the 150 figure level. So still no change, right? Using the 150.95 as my short-term pivotal resistance level. We also coincide with the downward sloping 20-day moving average. So as long as this 150.95 is not surpassed to the upside, we'll still maintain the intraday bearish bias. But first near-term support level equal to break down below it will be at 14910 for today. Over here, this minor congestion area here that took shape during the US session. New near-term support level to watch, 14910. Only a breakdown below 14910 risks a further downside for the dollar yen to revisit 147.95 next. However, if price action starts to do a swift up move above 150.95 for hourly close above it, today's intraday bearish bias will be invalidated to kickstart a minor corrective rebound scenario, revisiting 151.65 followed by 152.20, which is the upper limit of that medium-term descending channel, and the 200-day moving average acting as almost a similar resistance at 152.20 as well. All right, so net in the nutshell, still watching the 150.95 short-term pivotal resistance level to maintain that intraday bearish bias on the dollar yen, except that we have a higher first support level to watch for today, will be at 14910 on the dollar yen. All right, so that sum up the intraday technical outlook on the major dollar FX pair. So now let us focus on the major stock indices intraday technical outlook, starting with the Hong Kong 33. Still recall that Hong Kong 33 yesterday we flipped to a bullish bias because we do reckon that the minor push down from 27th of February all the way down to Tuesday session low is considered as a corrective decline sequence within its medium-term uptrend phase that is still intact, as price action still holds above the 20 and the 50-day moving average. And indeed, the price action managed to clear above our first resistance that we have yesterday at 22,850, and right now managed to test the second resistance that we highlighted yesterday as well at 23,430 before shipping that pullback as we are speaking right now. No clear signs of a exhaustion in terms of momentum. In fact, momentum is rather strong right now. Why? Because price action continues to see a bullish breakout on the hourly RSI and yet to hit the overbought region. All right, it hasn't hit the overbought region yet so far on the hourly RSI. So with that, upside momentum still remains intact potentially on a intraday basis as we're speaking right now, as depicted by the hourly RSI. So with that, we will have a tightened key short-term pivotal support for today, with the first support to watch out for will be at 22,850. I don't put it so tight unless we have an hourly close above 23,430. Then I will tighten the short-term pivotal support level to 22,850. So for now, the short-term pivotal support level will be shift up slightly from 22,130 yesterday to 22,470 today, which correspond to the 20-day moving average as well, and very closely to the lower limit of this medium-term ascending trend line that I drew from the low of 14th of January. So with that, still maintaining that intraday bullish bias with a slightly higher tightened short-term pivotal support at 22,470 for the Hong Kong 33. Above 23,430, potentially may see a retest of that of the previous minor swing high of 26th of February and 27th of February at 23,830 next. Above it sees 24,190 slash 24,510. Only a sudden push down with an hourly close below 22,470 invalidate today's intraday bullish bias to kickstart a minor corrective decline sequence on the extension to the downside, exposing 22,130 followed by 22,690 next, okay, which is the minor swing low area of 13th of February. Okay, so onwards next will be the Nikkei 225. So the Nikkei 225 represent, which is the Japan 225, managed to actually plummet as expected and hit our support level before staging the rebound that is taking shape right now. All right, as we are speaking. So right now there could be a further push up, a retest again, because of the hourly RSI has really exited from the oversold level and has yet hit the overbought level. All right. So now the pivotals, adjusted pivotal resistance for today will be taking into account of this minor trend line resistance, okay, that was highlighted. So in fact, it should be this here over here. Okay, so with that, I do a Fibo retracement. So the 50% Fibo retracement will be at 37,930. So let me adjust it slightly higher. 37,930. Okay, which is also the upper limit of the right exactly as this minor descending trend line from the high of the 18th of February. Okay, so let me change this to 37,000. Oops, sorry. Okay, 37,930. Okay, so 37,930 will be our short-term pivotal resistance level to look up to maintain that another round of intraday bearish bias on the Japan 225. First near-term support level to watch will be higher for today at 36,940. Only a breakdown below 36,940. Revisit 36,450 slash 220. However, if we start to see a bullish breakout with an hourly close above 37,930, short-term pivotal resistance, today intraday bearish bias on the Japan 225 will be invalidated to see a kind of a corrective rebound sequence to revisit the upper limit of that complex sideways range configuration again. Next resistance zone to watch out for 38,325 slash 490. Above it potentially sees 38,835 next, which is the 76.4 Fibo retracement close to the 200-day moving average, and as well as the minor swing high area of 21st of February. All right, so using 36,930 as my short-term pivotal resistance level, as long as this level is surpassed to the upside, potentially there could be some form of bullish intraday bias that may re-emerge back to the Japan 225 thereafter, but with a higher short-term support level to watch at 36,940 next. All right, so that's for the Nikkei 225 represent or the Japan 225. Upward next will be the German 30. So the German 30 yesterday do a very nasty choppy move. So initially we have a very tight short-term pivotal support level at 22,710 over here because of this symmetrical triangle, minor symmetrical triangle range breakout. Thereafter, it just plunges all the way down before shipping that V-shaped recovery again, right exactly at the lower limit of that former minor symmetrical triangle range support level and the 20-day moving average. So what we could see over here is that yesterday's intraday move was rather vicious, neither bullish or neither bearish because of the thereafter strong rebound right at the 20-day moving average. But because of it reintegration back below this dotted red line here, which is the former range resistance of that minor symmetrical triangle range configuration, the prior day bullish breakout, right, of Monday is considered as a failure bullish break. But this failure bullish break managed to survive at the 20-day moving average yesterday. So with this kind of rather mixed technical elements, right, I have no conviction now in terms of directional bias for today on the intraday basis, unless I need to have another day of price action to decipher what's going on in the very short term for the German 30. In the longer term basis, the medium term trend is still remains intact because price action still remains above the 20 and the 50-day moving average so far. But it's only on the very short term intraday basis, elements are mixed, and because of this, I have no conviction of any directional bias that I have that I can come up with on the German 30. So with that, I will rather flip to a neutrality stance for today and wait for more price action to formulate a intraday view tomorrow. So using yesterday's level, breakdown level at the 22,950, which was also the former all-time high area over here on 19th of February. So that will be my upper limit of my neutrality zone, and also close to the rejection candle, the bearish rejection candle that was formed at the close of yesterday's US session. All right, at 22,950 as well, very slightly below it, the high. So neutral between 22,950, lower limit for sure will be the 20-day moving average and the hammer, the hourly hammer candlestick low yesterday, where it shaped the V-shaped intraday V-shaped recovery at 22,310. So neutral between 22,950 and 22,310 level. All right. So unless we have an hourly close during and a breakout above 22,950 during the European session, then that I could validate a bullish bias for it to revisit 23,300. Then thereafter, the next resistance level defined by a Fibo extension cluster at 23,600 next. All right. So in a nutshell, mixed element, no conviction of a directional bias, flipping to a neutrality stance for today at 22,950 upper limit, lower limit 22,310 for the German 30. Onward next will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So what it did yesterday is that yesterday it broke down within our expectation and almost hit the support area at the second support area at 42,210. And most importantly, if you look at the daily time frame chart over here, it has a daily close, very clear daily close, below a major ascending channel support drawn from the low of 1st of November 2023. So what it means that yesterday's price action, okay, with the breakdown, with the daily close below this major ascending channel support, more or less increased the odds of a ongoing multi-week corrective decline sequence in the first step for the US Wall Street 30, representing the Dow Jones Industrial Average. So with that, I would have a very tightened key short-term pivotal resistance for today. That will be 43,120 slash 42,980. So 42,980 slash 43,120. So this will be my Titan short-term pivotal resistance zone for today, which was also got rejected yesterday as well during the close of the US session. Okay, it got rejected, and right now it's just trading sideways as we are speaking. So 42,980 slash 43,120 short-term pivotal resistance level still maintain that intraday bearish bias on the US Wall Street 30. First support level to watch out for today, 42,210. A breakdown below it exposes 41,980 slash 41,770, which is also the 200-day moving average, and as well as the 2.618 Fibo extension taken from the all-time high area at 31st of January, and also the swing low area of 13th of January as well. All right, so that is the this the current all-time high is the 31st of January, almost there. All right, so only an hourly close above 43,120, reintegrate above the former major ascending channel support, now turns into a major pullback resistance that will invalidate today's intraday bearish bias and also yesterday's major bearish breakdown situation to see corrective rebound scenario first in first step, revisiting 45,520. Above it says 43,885 next. Right, so that's for the US Wall Street 30, still maintaining that intraday bearish bias with a tightened short-term pivotal resistance for today at 42,980 slash 43,120. Lastly will be the Nasdaq 100. So the Nasdaq 100 plummeted as expected and managed to actually do a whipsaw around the 200-day moving average and try to survive right now as we're speaking. So what you could see over here is that there is no bullish divergence. Price action continues on the RSI, move in line with the price action of the raw price action of the Nasdaq 100, lower low, similar lower low on the Nasdaq 100. So this move up over here may not be able to see a much more significant rebound move, given there's no bullish divergence on the hourly RSI. So with that, we will still maintain the intraday bearish bias, but I don't want to tighten my short-term pivotal resistance to be too tight for today's rejection level during the close of the US session that was at 20,720. So this will be still my first resistance level to watch, just in case of any whipsaw. Higher levels will be my pivotal resistance level, that was the rejection level on Monday, 21,030. So as long as any bounce didn't surpass above 21,030, we'll still maintain that intraday bearish bias for the Nasdaq 100. Below 20,070 exposes the next near-term support area at 19,910/19,840. Okay, which is the minor swing low area of 1st of November and 4th of November last year. Only a push up and the hourly close above 21,030 will invalidate today's intraday bearish bias to see another round of minor corrective rebound sequence unfolding, heading up towards the next near-term resistance at 21,310 level, which is the minor swing high area of 26th of February and 27th of February, and so close to the 50-day moving average. Above it may see 21,000, above 21,330 may see a further push up towards 21,560. Right, which is the 20-day moving average, acting as a very similar resistance level as well. So that sum up the intraday technical outlook on Nasdaq 100 and as well as the major stock indices. So let us now focus on the commodities market, starting with gold XAU/USD. So for gold XAU/USD, yesterday we do have a bearish bias below the 20-day moving average at around 2,903. 905 price action break above 2,905, hit the second resistance at 2,923 before trading in a sideways range configuration, but still holding above the 20-day moving average as we are speaking right now. All right, so hourly RSI managed to bounce off from the 50 level mark over here. Right, there's some support level that mentioned bounce. So it seems to us that yesterday's hit of that the test of that next resistance, next short-term intraday resistance at 2,923, this price action over here could be a potential bullish pennant formation. Okay, this pattern here. Okay, let me remove the maniac. Okay, so this pattern over here could be potentially a bullish pennant formation. Okay, this pattern over here. All right, hold it since it's managed to hold above the 20-day moving average. So with that, and I do the Fibo retracement of the entire rebound from the low of last Friday all the way up to yesterday's high. The 50% Fibo retracement is at 2877, which is also a graphical support level as well. You can see very clearly here, there's a graphical support level. So using 2877 instead of the first resistance at 2900, 2890 level over here, which is this zone. Okay, because just to prevent any whipsaw, all right, I'll use a slightly level 2877. So as long as 2877 short-term pivotal support holds for today, we will flip to a intraday bullish bias stance because of the positive price action that's playing out right now, supported by a positive daily RSI momentum reading. Flip to a bullish stance or bullish bias for today on the gold XAU/USD above 2,923 in the first step, may revisit the current all-time high area at 2,954. Only a breakdown with an hourly close below 2877 will reinstate the bearish bias for the another round of extension of this potential minor corrective decline sequence, retesting the minor swing low area of last Friday at 2845/2834 in the first step. All right, so this is for gold XAU/USD. Given the current positive price action development that I discussed earlier, we will flip to a intraday bullish stance for gold using 2877 as my short-term pivotal support level. Okay, so that's for gold XAU/USD. Lastly, will be the West Texas crude oil. So the West Texas crude oil plummeted as expected due to a potential slowdown in economic growth, despite the fact that there is some form of positiveness coming out from the China 2 session, but that is not enough to offset the negative feedback loop that is taking shape on global trade or global demand on oil. Especially there's this form of tit for tat measures coming out from Canada, Mexico next, and potentially if uh, uh, other countries like China as well that may start to implement more forceful tit for tat measures. So that kind of spook global growth eventually also lead to a negative demand outlook for demand for oil price as well. So that's what explain why the oil price plummeted yesterday from a fundamental perspective. And from a technical analysis perspective, still no change. Price action managed to hit the first support level at 67 level, 67 figure before staging a bounce and got rejected over at the former minor swing low of 27th of February. So for a better reward risk ratio perspective, I would tighten my key short-term pivotal support for today from 69.50 to 68.80, right exactly at the rejection level from the last hour of the US session, 68.80. So using a tightened short-term pivotal resistance for West Texas oil, will maintain the intraday bearish bias at 68.80, only push down to retest 67, a breakdown below it exposes 65.95/65.70. We also the lower limit one-time Fibo extension, the lower limit of this medium-term descending channel that I drew from the high of 16th of January. And if you look at 65.70 is also a key medium-term pivotal range resistance range support level, 65.70, key medium-term pivotal range support level that is in place since the major swing low area of 20th of March 2023 over here. All right, so this is very 65.70 is a key medium term pivotal range support level as depicted on the hourly chart from here. So with that, we still maintain that intraday bearish bias using a tighten key short term pivotal resistance for today at 68.80. Only a hourly close above 68.80 will invalidate today's intraday bearish bias to see a squeeze up for a mean reversion rebound sequence towards the upper limit of that medium term descending channel. In first step, 69.50, above it sees 70.80, which confluence the minor swing high of 28th of February and 3rd of March, and as well very closely to the downward sloping 20-day moving average and the upper boundary of the medium term descending channel. All right, so with that, that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for? So there are a couple of data to look out for today, especially up from the US side of the story over here. Okay, let me put in calendar. All right, so today will be Wednesday. All right, over here. Let me go all the way down. Okay, here. All right, Wednesday. So the next data to look at over here is during the European session opens over here, where we get a slew of finalized services and PMI data. Previously was preliminary, that was released about 2 weeks ago. So this is the finalized figure from Germany as 4:55 p.m. The combined Eurozone one will be at 5 p.m. So this figure shouldn't be much change from the preliminary one, so may not have so much impact on the respective FX pair, the German DAX and as well as the Euro dollar. Then followed by, the next one to look out for will be the PPI. So PPI data may impact the Euro dollar because this is considered as cost of business in Eurozone. So PPI market is expecting a slight uptick from 0% to 1. A slight reversal from 0% to 1.4% year on year in January. So that will be releasing at 6 p.m. Singapore time. Then thereafter, as we head into the US session, there's this tier 2 US labor market data, something like a prelude to the all important Friday NFP figure. So ADP unemployment change is more being compiled by the private sector. Market is also expecting a very low ball number of 140K. That could be easily be met because the previous number is 183K. So ADP employment change will be out at 9:15 p.m. Singapore time. Then thereafter, we have two Bank of England officials speaking, the governor himself, Governor Bradley speaking at 10:30 p.m. Similar timing, we have BOE Phil speaking as well. Right, and Another very important data pertaining to the major US stock indices and the major dollar pair will be the ISM services PMI. So we know that previously the another services PMI compiled by the S&P company shows contractionary mode in the month of February. So market now will be focusing on the ISM services PMI, whether there will be a slowdown as well. So market is expecting almost no change. Previously was 52.8. Market is not expecting 52.6. And also what's important is also the sub component over here, which is the services prices. So the manufacturing price, the ISM manufacturing prices also rose rather steeply 2 days ago. So market will be paying close attention whether the services industry in US faces the same price pressure as the manufacturing services. Okay, because so far, if you look at the trend of the services price subcomponent, 60.4, that was the previous month of January, it continues to trend upwards rather significantly. Right, so if you look at the 10-year trend, right, it starts to like doing a bottoming kind of formation from the low of March 2024 last year. All right, so if it continues to inch up higher and goes above 64.4, that was the December high, that could also increase the risk of a stagflationary-like scenario in the US, given that market participant now has a realization that potentially economic growth may slow down in US due to Trump's hawkish trade tariffs policy against almost the rest of the world, rather just China alone, and that could also cram down on earnings growth prospect as well. So that will explain why we start to see a rather lackluster performance of the US stock market since the start of this year versus the rest of the world, which I did cover previously in some of my intermarket dynamics in my previous daily dose. All right, so let's have a quick look at the calendar to see what other data to look out for after this 10 the 11 p.m. mark, where the ISM services PMI will be released together with the subcomponents. We have the weekly EIA crude oil stockpile change that may impact the West Texas crude oil prices on an intraday basis. They'll be out at 11:30 p.m. Singapore time, and thereafter that should be it. Yep, that should be it. All right. So that is the today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you very much.